Hello, this is John Kvale, and this is our Q4 newsletter video. I've got a lot of content here, so I'm going to really scoot. First of all, I'm going to get myself out over in the corner. Here we go. And let's get rolling here. For those of you that are on the road, we do this in a video, audio, podcast type of format. I'm trying to move steady so I don't shake you around, those of you that are watching the videos. So if you're driving down the road listening to this, keep your hands on the wheel and drive safe. Let's get into it. As I mentioned before, this is our Q4 video, newsletter, podcast review. The lead article, those of you that are in listen-only mode, I am scrolling over the actual post, which includes, I'll go back, which includes this neat spot where you can get to the newsletter and see it. You can make it bigger. You can, unfortunately, when you get the email, it does not show this way, but those of you that are in listen-only mode, I'm showing all the hot links to the actual newsletter that you can download. And those of you that are clients, this is headed to your house in nice colored format from our New York printers. Rate increases are good for pension and pension plan recipients. What? Yes, I'm not kidding. I ran into a fantastic white paper and some great research from Milliman, and which is a big insurance company, and they have a big research department, and they do some pension plans, pension plan reviews, consulting. And bottom line, I got a hold of a nice young lady, Rebecca, who is the co-head of media relations, and she said, sure, you can go ahead and post this on our blog. So here we go. Bottom line on this. Here are the top 100 pension plans. These are some names that you would know, legacy companies, even have a family member. My dad is this one right here, receiving a pension, long-time pension plan. I want to lead a long-time pension plan recipient, wanted to lead the newsletter with something really positive. And I usually always try and do that. Higher interest rates are meant to slow the economy, but they also have some other effects. And we're going to talk about the slowing here in a second in our second article. But when rates, those of you that listen only mode, I've gone to the chart, what was called chart 3 in this white paper by Milliman, which is just fantastic. And this is essentially the pension plan funding levels. Under 100 means you're not funded completely. Bottom line is, when interest rates, I'm scooting over that graph in 2007, when they slashed interest rates, there's a complex calculation called present projected benefit obligation. They have a PVPBO benefit. Anyway, this created an underfunding of a lot of pension plans. This has also created buyouts. The reason being is a pension plan is generally out of necessity. You have to hold a lot of bonds, and when they lowered interest rates, that made this pensions underfunded. With higher for longer and interest rates being higher, pensions are now caught up. This is a little bit of a lagging chart. Pensions are now funded. These are the top 100s. Should make pension plans feel better and pension recipients feel better. Two things. This is a very traditional pension plan calculation, not someone who has a pension plan for their company or things of that nature. And also, secondly, it's not Social Security. Social Security is a revenue tax-based plan. Here's the source data for this. So, all right, I try to make this a little bit funny. I'm moving on to the second main. That was our lead article. Moving on to the second main article, and it's Don't Fight the Fed. Wait, are we fighting the Fed? Yes, we are fighting the Fed. Was able to pull this graph together. This is my original graph, and this is the S&P, the almighty S&P 500, and this is the total assets of the Federal Reserve. That's the blue line, and that is the S&P is I call it the orange or the gold line. The deal is, the Federal Reserve, as they lower their assets, generally, not always, but as they lower their assets, it's an impediment. A higher increase in rate and lower their assets, it's an impediment to the economy. There's been a pretty good correlation over time with when they're putting money into the economy, it's a driver, and when they're taking money out, it's not. They're now taking money out. I'm on the very far right of the line. I'm going to go down here. They're taking money out. So far, people are fighting the Fed. How long will it last? Don't know. All right, true ups. I'm going to put some verbiage in there as well. But those of you that are in listen-only mode, I'm going up true ups, reminders, 401k, and the maximum for 401k, which the big behemoth is $22,500 for those under 50, and those that are 50 or older, any day of the year get to put in $30,000. This year, and so we're coming into the last 90 days of the quarter of the year. So if you've got one quarter, might be a good time to catch up. Pro tip number one: generally we want to contribute evenly. Pro trick number two: you can rush your overfund basically. And then I have one warning, which is don't overfund plans. If you had two different employees during the year, you will need to. We will help you make sure you don't overfund. And lastly, with new plans, always be aggressive. Cyber tips and tricks. I'm moving fast because I don't want this to get too long. I already say it's 5 minutes. Cyber tips and trick. Three different things. Basically, a lot of cyber stuff for the rank and file. This is not for the super sophisticated people that are breaking into NASA or the like. I'm exaggerating. It's a pretty straightforward. It's usually something simple. The second thing is, or the first, that's the second thing. The first thing is most of the time it's a simple intrusion within an email that you click. I've got 3 handy tips in here. Tip number 1, 2, and a USB pen drive. I'll let you read that in the newsletter that's coming as well. Okay. I have another article that I'm going to keep this short on this because I'm making a post completely on this. Those of you that are, my computer just went into, we'll see if that edits too bad. My computer just went into a safe mode, so hopefully it doesn't get too, I'm at the end of this. It's battery. RMD age change and important other dates. The RMD dates have changed dramatically from 70 and a half, and 72, 73. Bottom line is they're 73 right now. And they will turn to 75 in 2033, if not sooner, if they don't adjust. And then lastly, Social Security maximum age is 70. I do something kind of fun in here, which is basically what's the word I'm looking for? 75 is the new 65, and so Social Security still mandates that you take it at age 70. All right, that's it. I'm about 7 minutes, so this is a little long. Thank goodness I have fast Wi-Fi here at the house. Special thanks to all of you, the new folks that are listening. We do this every quarter, and then I do a monthly review as well. So there's a lot of video of me. I like to do this just because it gives a little bit more. These are all original articles, but it gives you a little bit more insights to what I was thinking when I was writing. Thank you so much. We'll talk to you at the monthly review, and this is the review of the newsletter. Have a great day.